I have been no stranger to calling out Nikola stock. I've made about 4 videos over this company over the last 3 years or so, and it's one that I've always found as a complete fraud, one that I think is going to bankruptcy, and it's news like this that I think mislead investors of Nikola striking a hydrogen-powered truck deal that sends the stock soaring. Now, if you didn't know already, this is a company that was previously headed towards bankruptcy. If you look over just the last year or so, you can see that this company reached a low at around 50 cents, when just 1 year ago it was around $5. So it was down about 90% in a 1 year span, and this is a far cry from its all-time high previously around its SPAC IPO at around $80. Now $80 is a far cry from 50 cents, and this company is now in an uptrend. If you look over the last 3 months, it's up 147%. Just over the last week, it's up over 50%. And you can see that this company is starting to have a bit of a revival, and it's because of news like this that I think investors typically get the wrong idea. We're going to give an overview in this video why I think Nikola is still a scam, why I think it's a company that's going to zero, and honestly, if it's a company that in your opinion, you think is going to go to the moon, it's going to go to $5, $10, $20, I think you're heavily mistaken, and I think there's some things you need to consider. We'll give a couple of bullet point items in this video. For example, we're going to look at projections for the company, what its earnings and revenue will look like, or I should say lack thereof. We're going to talk about shares outstanding, what that actually means for businesses like Nikola, and issuing new stock and how it affects you as an investor, and what this company's been doing over the last couple of quarters in regards to that. Finally, we're also going to talk about this company's availability of debt, if they're able to issue debt at all, and if so, what rates will they be able to issue them at, and will it be able to weather this storm of getting through this potential recession opportunity, high interest rate environments, and overall just stay alive as it burns through its major amount of cash, which of course, like everything else in this video, we're going to give a full overview of the company and talk about where its cash pile has been going over the last year or two. But other than that, guys, if you haven't seen me before, my name's Jordan. Here's my portfolio balance over time, my performance year to date. But thank you guys so much for watching. Thank you for tuning in. And I'm not going to drag this out, so I'll go ahead and start by diving straight into Nikola. Now, like I said, I've spoke about Nikola in the past, and this is one that so far has done very poorly. Now, like I said, I've made several videos about this company, and so far they've pretty much spoken the truth on the direction of where the company has gone. Ever since their initial SPAC IPO reaching about $80, they've been straight down. And this is mostly due to their cash pile that they've been burning very, very fast. Now, what I want to show here is the cash that they have on hand quarter after quarter. This is not an annual chart. This is every 3 months. Now, let's go ahead and look at September of 2020, when this company first went public and they got all the cash from selling their shares to the public markets. You can see that they had around $900 million of cash outstanding as of the third quarter of 2020. Now, if you go just 2.5 years later and go to the first quarter of 2023, just 2.5 years later, that $907 million of cash is now turned into $121. Now, not only have they burned most of their cash, but they've also raised debt during that time as well. Because when this company first went public, they had no long-term debt, and now they also have about $300 million in outstanding debt. So if you actually were to factor out that debt, if they didn't receive those loans, they actually already would have burned past their entire pile, because they only have 121 left, but they have 300 in that red line of outstanding debt for long term so far as well. Now, here's the thing. This company is projected to grow revenue over time. Last year, they put up $50 million in revenue. This year, they're projected to put up 143. The next year, they're supposed to put up $500 million. I don't think that'll happen, but we'll see, because so far, this is a company that is running at almost no revenue. So far, they put up anywhere from a high of around $20 million in revenue, and currently they're putting up around $10 million. Now, $10 million sounds great until you realize that this company is over a $1.5 billion market cap, because they are currently selling a lot of shares. Now, speaking of which, that's something I wanted to speak about. Shares outstanding. Now, Nikola falls short of winning shareholder support to issue new stock, but there may be a new law to help. Now, the one part of this, I'm not sure about this law, and I don't really care to argue or debate about it, because the main thing I want to talk about here is shareholder dilution in general. Is this something that will benefit shareholders? Is this something that will benefit Nikola? And is this something that you should be excited about for someone that's wanting to invest in this company? Well, if you don't know, if you're new to the stock market, or if you're not aware about how shares outstanding work, this is essentially how it works. These are fraction numbers. These are circles of pi, for example. And think of this, you can look at this as a slice of pie or slices of pizza. Or in this example, like me, you need to look at this in terms of a percentage of a company that you own. If you have a business with one partner, you and one other guy, you own half the business. Now, if for whatever reason y'all sell off a part of that business and there's now three of you, you no longer own 50% of the business. You own one third, or about 33.3% of the business. Now, same if you keep going, if you add another partner and there's now four partners, instead of your original 50%, you now own just 25% of the business. And this goes on and on and on as you add more and more partners. Now, the thing to look at here is take a look at this example and pretend, for example, that all the shares of Nikola is this 1 out of 10. Make it easy. You own 10% of the company, hypothetically, for every share that you bought. Obviously, that's not the case. You own a microscopic percentage because there's hundreds of millions of shares outstanding. But for simplicity's sake, let's pretend that you own 1/10 of this. Now, how is the company doing in terms of issuing shares outstanding? Well, the company is issuing back stock in a big way. They've issued 30% more shares year over year than what they did just 12 months ago. There's 550 million shares outstanding today versus 1 year ago, 415. So to put this in perspective, this is about the same. That's around a 30% increase. That's almost identical from going from this 1 to 7 chart up to this 1 to 9 chart. That's about a 30% increase. So this green slice that you owned right here in 1 year is already reduced to this smaller green slice right here. The same thing could be said if you owned the 1 to 10, and if it increased all the way to 1 out of 13, you would have a smaller slice. You get the point. You can see that the company is issuing back tons and tons of shares because just 1 quarter ago, just 3 months before their last earnings report, they had 487 million shares outstanding. So think 1 out of 487 slices of pie to an increase of 550 shares of pie, or 550 million shares outstanding. To have 487 shares to 550 million shares in just 3 months is a massive increase. If I'm doing that math right, I think that's right around a 15% increase just in 3 months in 1 quarter. So that is a massive increase in a short amount of time. Now you might be looking at this and you might be saying, Jordan, okay, they might be issuing stock and this may be the way that they plan on saving the company, but this will give them a lot of cash on hand to burn through. This is a lot of money that they can use to build factories, to expand their research and development, hire new employees, and then obviously sell more products in the future. You would 100% be right. And that would be the only thing that would save this company from bankruptcy, because this debt right here. You see that they did issue some debt back around the summertime last year of 2022, so right around 1 year ago. And this is mostly coming from this deal right here in May of 2022, May 2nd of 2022 to be exact. And Tara Capital lends money to startup at 8% cash or 11% interest in stock through 2026. And that was for about $200 million. Now here's what's interesting here. 8% or 11%, depending on whether or not it's cash or stock. Regardless, you can see at the midpoint there, they're selling interest on stock or interest on loans at around 9-10%. Now, when was this? Like I said, May 2nd of 2022. Now, this is the federal funds rate. If you're not sure what this is basically that when people say, hey, what are interest rates at right now? This is normally what they're talking about, the federal funds rate. This is essentially if you lend money overnight to the federal government, what will they pay you in interest? And these normally dictate the amounts for savings accounts and CDs and lots of other things. Pretty much anything that has a rate on it comes from this. So to state the obvious, the higher this goes, the more expensive debt is, which is why just in a couple years you have, say, home loans going from 3% up to about 7% now. It is derived directly from this federal funds rate. Now, where were we in May of 2022? We were under 1% on the federal funds rate, 0.77 as an average of May 2022 to be exact. And so far this year, just a little over a year later, we're at over 5%. 500 basis points has went up for the federal funds rate, and that's before this company even had a chance to issue any type of debt this year, because mostly, in my opinion, I don't think that they realize that it's not economically viable to do so. If they were to raise debt now in this environment, just a little over a year later, this rate of 8%, 11% is no longer the new rate at which this interest is going to be sold at. My guess is that the interest rate that they would get for issuing any type of debt or equity in terms of interest on stock like this deal was, I would say at minimum 15%. My guess is it would probably be in the range somewhere between 15 and 20%, and that is very hard to make money on invested capital at a rate of 20%. When you actually put return on capital employed in terms of an actual chart, you need to have more than 20% returns to even break even because your loans are so high. Now, this company not only doesn't have 20+% return on capital employed, they actually have right around negative 20% return on capital employed rates, which is obviously the complete opposite, which is what is leading this company to burning through cash at big ways and burning them at really fast rates and issuing lots of debt just to try to keep the company afloat. That is what has taken this company in one short year from a $5-6 stock all the way down to 50 cents just a couple months ago. And now you're having some activity via short squeeze, getting investors excited in this company again, going from 50 cents all the way up to $2 plus just in a couple weeks. Now, this is something that as an investor, you should be scared of. You should shy away from this. Now, I did want to let you know, this is not a company that I'll be shorting currently. I did have it shorted around the times that I was shorting these company, right around late 2021 in November, and I did make some money going against the company. Now, why am I not shorting it now? It is primarily due to the fact that two reasons. One, Fidelity won't even let me short it if I tried. So they took away that option because there's a short squeeze going on. There's too many people betting against the company. They don't even give me the option even if I wanted to. Second, if I were to bet put options against this company, say that, oh, it's going to go down big time over the next year, which in my opinion it probably will, it has to go down so much because investors are already betting so heavily that it's going to go down that bankruptcy is almost inevitable at some point. So it's very hard to make money off of options, off of betting against this company, unless it not only goes down, it doesn't go down to $1, to 50 cents. It pretty much has to go to zero, and it has to be there pretty much within the next 12 months for you to make realistic money on options. Now, I do think this company will go bankrupt. I think zero is inevitable. The only question is when. It depends on how many shares that they sell to the public, like this article that we read right here. If this were to go through, it would keep the company afloat for probably another year, 2, maybe even 3 years or so. And also if they're able to raise more debt via deals like this that they did a year ago for $200 million. Now, here's what I do know. I know that this company will probably fight to stay alive, and they'll probably start to get some revenue as they scale up their business. The only problem is, how long will that last until they completely run to zero? When this green line goes lower and lower and lower and eventually hits $0, that's when you reach bankruptcy. And that's when basically all stocks on the market that reach bankruptcy go to $0. That's where this company, Nikola, is headed. And if you're betting big on the company, my advice would be don't.